So it represents the change in the total cost resulting from the producing for an additional unit relevant of short-term decision making, which is always suitable for the short-term decisions making, because each and every time the production cycles will be keep on change. So which is always depending on the short-term decisions making. Fixed cost or any cost, it won't change, which is always constant, but variable cost keep on change. Hello everyone, a warm welcome to one and all. I am Natesh, lecturer in commerce, Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. We are in the Unit 4, Session 1, 4th semester, B.Ba Management Accounting. So, which is the chapter name is the Marginal Costing. Okay. And moving forward for my today agenda, so which is you will get more clarity about the marginal costing. We call it as a variable cost. Okay, one more name is variable cost. And what is the marginal costing? Okay, margin cost and marginal costing difference, you will get more clarity. And what are the features of marginal costing? Why as a management they are at the time of taking a decisions using a marginal costing tool. Okay, and the break-even analysis. Okay, break-even means what? There is no profit, there is no loss. You will get more assumption. Okay, and the break-even analysis, where exactly usage. Okay, the application part. And the terms used in the marginal costing and the break-even chart, you will get more clarity for coming slide. The first one you will get what is the marginal cost. There is something different name is called for the variable cost also, because the fixed cost which cannot be changed. Okay, but marginal cost which is keep on vary because of material increase or decrease. Okay, even the labor hours, even the other expense which is increasing. Okay, increase or decrease. Here the meaning and definition: marginal costing refers to additional cost. Okay, so additional cost incurred by producing one or more unit. Margin means what? Extra you want to think here. So product and providing one more unit of service. So the same the space whatever it is available, if I try to increase one product, obviously we can get the maximum benefit. So it represents the change in the total cost resulting from the producing for an additional unit. The same space, the same resource, the same machine, we are trying to produce extra unit. In other words, it measures the cost impact to produce and providing a single additional unit. Okay, so using the source, input resource, we are trying to increase one extra sales. Productions. Okay, under marginal costing, so whatever in the previous slide which is completely margin cost. Okay, now marginal costing. So meaning and definition: marginal costing is a costing technique that focus on the behavior of cost. There are major two costs we are identify: fixed cost and variable cost. Okay, so fixed cost, any cost, it won't change, which is always constant, but variable cost keep on change. And their classification into fixed and variable component. It involves the segregation of cost into fixed cost and variable cost. Okay, the analysis of their impact of the profitability of an organization. As a management, they want to take a proper decision about the fixed cost as well as variable cost to increase additional productivity. Okay, so marginal costing emphasizes the determinations of the marginal cost and their comparisons with the marginal revenue. If I try to produce one extra product at the same time, I am getting a revenue generation. So using the same source, the fixed cost, for example, the building rent which cannot be changed, which is always fixed. But the same space I try to increase for increasing the productivity, the building rent is always same. Okay, so which is building rent which is coming under the fixed cost. Okay, if I try to increase one more product, what is the additional raw material is required, even labor is required, and additional expenses are connected. Okay, to make a decision about the production, pricing and resource allocation. If I try to produce mass production, I try to decrease the price of the product. Okay, so that is actually the management want to take an advantages. Even What are the features of the marginal costing? So obviously marginal cost, the production which is major cost we identified, one is related to fixed as well as variable cost. Variable cost can be your material, labor, okay, or other expense which is variable expense which is keep on varied. But fixed cost which is always fixed, which is constant forever. Okay, either you are trying to produce for 10 product or 20 product, the fixed cost cannot be changed, which is a constant forever. So contribution margin, so we are trying to find out what is an additional. Okay, so obviously there is very simple formula to find out the contribution: sales minus variable cost, which is giving you a contributions value. So that additional, what, how much you are producing. Of course, which is a decisions making tool as a management, when they are trying to using the marginal costing analysis, of course they are trying to take a better decision. Okay, so the profit volume relationship between the cost, profitable, number of unit produced, okay, everything we need to measure based on the profit volume only. So how many quantity you produce, what is the sales value, which is coming under the relationship between the total cost and profit, revenue generation. Okay, and the relevant of short-term decision making, which is always suitable for the short-term decisions making, because each and every time the production cycles will be keep on change, so which is always depending on the short-term decisions making. And a simple and easy to understand, there is very simple format we are adapting for preparing a marginal costing, so easily you can understand. Okay, so moving forward, so break-even analysis assumption. So you want to get more clarity about the break-even analysis. Break-even means what? Break-even point means there is no profit, there is no loss. We call it as a break-even point. So in this case, the profit volume relationship between the number of cost which is incurred, fixed cost, variable cost. Okay, so the difference what we are finding, the contribution, okay, which is always calculated profit volume. And next, relevant to short-term decision making. So assumption we are taking for decisions, right? So which is related to the productivity. If I try to increase the production, so what is the cost I want to bear? Because the fixed cost cannot be changed, which is constant. So next, again simple and easy to understand assumption, and the linear relationship between the cost as well as profit. Okay, so unit as well as revenue generation. So linear relationship, cost, fixed cost as well as variable cost. And the constant sales mix. So the constant sales mix means actually there are different types of cost you want to bear for the expecting the sales. There are different costs are incurred, right? So that's what. So fixed costs remain constant. In this case, very either you are the same space you are using to produce 100 or 200, the rent cannot be changed, which is always fixed. Okay, again single output level, because each and every time when you are trying to adapt the marginal costing technique, so which is a single output level we can find out. Okay, so next one, constant selling price. Why we are preparing a marginal statement, marginal cost statement, to find out the selling price, how much I want to fix the price. Okay, so for that reason. And break-even analysis uses, there are different management are using a marginal costing. So because the break-even, there is no profit. If I'm getting a loss, means why should I go for producing the product? So that's what I need to find out, either I'm getting profit or loss. So using a break-even analysis, where exactly, so determining the profitability. Everyone, all the businessmen, if the management are, they want to determine how much I want to get profit. So determination part. And the pricing decision, at the time of setting a price, or I want to fix any price, blindly I cannot fix. I want to take an advantages from using a marginal costing. So I will get what is the cost of the product, okay, and how much I can sell, what is the variable cost, how much I can change. So everything I decide. So even the cost control, majorly we are talking related to fixed cost and variable cost, how I can try to control the cost for variable cost. And product mix, because the product is finally there are number of mix, which is the design part, how much I am spending, okay, labeling, packaging, so everything which is related to the product mix. Of course, the sales forecasting. If I'm using a break-even analysis, so easily I can forecast the sales. If I try to produce what is my demand, how much I can supply, what is my target customers, so everything I can predict here. Moving to the term used in the marginal costing, so profit volume ratio, okay, so PV ratio is very important. So the profit volume ratio, also known as the contribution marginal ratio, so we call it as a contribution marginal ratio. So you need to get how you are getting a contribution, sales minus variable cost. If you try to subtract, you will get the contribution, okay, which is called also contribution margin ratio. Is the ratio of contribution margin, that is the difference between the sales revenue minus variable cost, okay, the sales minus variable cost, no doubt, which is a contribution, okay, to sales revenue. It represents the portions of each sales rupee that contribute to covering the fixed cost and generating profit. So after getting contributions only, we are trying to subtract the fixed cost. So after subtracting fixed cost from the contribution, so we are getting a profitability. So we are talking related to profit volume relation, so which is related to sales variable cost, then we are getting the contribution. From the contribution, if you try to subtract fixed cost, we are getting a profit. So which is mainly focusing on this three item. And the formula to find out profit volume ratio, so the contribution divided by sales into 100. So after calculating contribution, how you get to know? Because of using a format, okay, the statement we are using. So with the help of contribution divided by sales into 100, so the profit volume ratio, once you identify the profit volume ratio, so we can apply for the next techniques. Okay, and next one, break-even point. So the break-even point means exactly we classify, we can identify there are unit base and sales base here. The break-even point is a level where exactly which is a intersected point. So if you are seeing the graph, you will get more clarity where exactly break-even point. The level of sales at which total revenue equal to total cost. There is no profit, no loss, because you are matching the revenue as well as cost, resulting in the neither profit or loss. It is a point where the company cover all the fixed costs and begin to generate profit. So at the time of break-even point, once you identify there is no profit, there is no loss, okay, obviously I can go for taking a next action plan. Here the formula to find out the break-even point units, okay, the first one fixed cost which is given in the question, okay, otherwise the fixed cost, whatever the cost per unit is given, divided by contribution per unit, okay, easily you can find out the number of break-even points of units, okay, how many units you produce. And if you try to go for break-even in sales or rupees or volume, okay, so the same formula, fixed cost divided by PV ratio, or you can take one more formula, fixed cost divided by contribution per unit into selling price. So this is also will get same answer, okay. And moving to the next one, margin of safety. You want to always safeguard yourself for setting a certain margin. The margin of safety is the difference between the actual or projected sales, which is given in the question. Okay, so using the break-even sales, we need to subtract. See how it is interconnected for the next formula. So obviously, marginal safety is the difference between the actual sales. Okay, so actual sales, margin of safety is equal to actual sales minus break-even point sales. Okay, if you subtract, you will get margin of safety. Okay, so it represents the questions and buffer the available of sales above the break-even point, providing measures how much sales can be declined before the company incur losses. Easily we can identify, okay, and the formula I have clearly specified here, actual sales minus break-even sales. How you get to know the break-even sale? We have applied a formula like a fixed cost divided by contribution per unit into selling price, okay. So the same thing you are getting. Otherwise what we are trying to get actual break-even sales, the simple break-even unit into selling price. This is also giving a same answer, okay. So moving forward for next one, angle of incidence. So the angle of incidence is the angle frame between the total sales revenue and total cost line is on a break-even chart. In the break-even chart, we can identify the angle of incidence, okay. So it indicates the rate at which profit increase okay, where exactly the locations we need to identify increase or decrease with the change in the sales volume. The steeper angle of incident indicate the higher profitability. In the coming slide, using a graph, easily you can understand where exactly the angle of incidence is located. And next one, break-even chart. So we are talking related to terms used in the marginal cost. It's very important to solve the problem. Okay, not only for the solving a problem, even the theory questions also you can expect 100%, 15 marks or 10 marks question you can expect from these chapters. Okay, the break-even chart, also known as a break-even analysis or break-even point, okay, is a financial tool used by the business to determine the point at which the total revenue equal to total cost. There is no profit, there is no loss in that case. Okay, so resulting in the neither profit or loss. Okay, it provide visual representation, the relationship between sales volume, cost and profit. So easily we can get to know what is my sales position and the cost, even the profit also. Using a graph, easily we can identify the complete visualization. The break-even chart is based on the concept of contribution margin. Concept, you know, the contribution calculation, sales minus variable cost. Okay, so which is the difference between selling price per unit and the variable cost will give you the margin contribution per unit. Okay, the contribution margin represent the amount that they contribute to cover fixed cost of the business. Okay, so easily we can get to know the, using the formula we can get to know the total cost, total variable cost, fixed cost, the sales volume, number of units produced. Okay, so everything we will get information. So here the break-even chart is very simple. So any production, okay, either you're starting 100 production or 200 production, the fixed cost cannot be changed, which is always constant. Okay, now variable cost, now we from y-axis we call it as revenue or cost beared, and the x-axis number of unit produced or quantity we can consider here. So we need to write the scale is very important. So fixed cost line is always fixed, either you're producing 100 units or 200 units, 1000 units, so which is a constant. Okay, so next one, from the fixed cost, the point, first you need to calculate the break-even units and sales. So once you calculated break-even units, number of units, okay, x-axis unit, and break-even sales, y-axis. So you have to, for example, the sales, break-even sales we got, for example, 10 lakhs we got. Okay, and even the break-even point units we got around 10,000 we got. Okay, 10,000 units produced. So for example, from the x-axis we need to mark for 10,000 units. So dotted line we need to extend. Okay, so till the 10 lakhs where we are getting from the y-axis. So here dotted line. So where exactly which is intersecting, so we need to extend the line. Okay, so from the fixed cost, when you try to touch for the this point, okay, so directly which is going for the total sales value. Okay, again here we can identify the total cost from here to we need to extend, right? So here the total revenue, which is always starting from the x-axis and y-axis origin place. So we need to extend till this point is reaching, we need to extend. So we call it as a total revenue. From total cost, how you are getting from the fixed cost origin place to, okay, intersected point. So we need to extend the line. So we call it as a total cost. So in this particular area, we call it as a profit, okay, or you can say angle of incidence. So in this particular area, we call it as a loss. Okay, I hope you clear. Keep on watch for next section. Thank you.